When it comes to taxes, one of the easiest ways to lose money unnecessarily is through penalties for underpayment. For retirees and high net worth individuals with multiple income sources, the estimated tax system can be confusing and costly if you get it wrong. Fortunately, the rules are clear, and there are smart strategies that can help you avoid penalties while keeping your tax life efficient. Today, we're walking through how to sidestep underpayment penalties and build a proactive plan that works with your retirement income. So Spencer, believe it or not, the federal government likes to receive tax payments. Individuals don't always like making tax payments, and individuals really dislike it when they have to pay a penalty because they underpaid for their taxes. So today we want to discuss what does it look like to estimate your taxes and how do you avoid those penalties. So walk us through that first key point here. They're the safe harbor rules.
Well, and even before we get to the safe harbor rules, there are reasons why we mess up here. There are certain types of income, there are certain types of investments where we can't withhold taxes. So if you think about a non-qualified account, let's say that you have interest income, you have dividend income, you have some capital gains coming in there. You're not able to take and push a level of that to the IRS. There's no mechanism for that. If you are a consultant and you're earning income and you're sent 1099 income, that you are not having any withholding on, then the federal government still expects you to pay that, but you've got to figure out how much there. So there are some good reasons beyond, what you might think, why people actually don't get as close as they need to here. The safe harbor rules are rules that basically say, hey, we're going to take our best effort to make sure that we pay enough, and if we don't, then we'll true up when we need to. So a typical safe harbor rule there would be, if you pay 100% of last year's tax liability, you're protected from underpayment penalties, even if you underpay this year, provided that you made less than $150,000 of adjusted gross income last year. If you make more than $150,000 of adjusted gross income, why then you need to pay 110% to be within that safe harbor. So let's just say, again, you've got income that is $150,000. Your tax bill, let's just say hypothetically, is $20,000 that you've got to pay. If you pay that $20,000 of income, or let's say it's $149,000. You've got $20,000 of tax that you need to pay. If you pay 100% of that liability from last year, you pay your $20,000 of tax. Then you're in good stead, even if you this year make a lot more, and then you need to pay more again by the federal deadline, for filing there. So you can make up there after the fact. So you might pay, $20,000 over the course of that 12 months or 12 months and 2 weeks up to, the estimated payment on January 15th of the year after there. But if you do that, then you are setting yourself up again to avoid those underpayment penalties. Another way that you can do this within the safe harbor rules is you can pay 90% of this year's actual liability. So if you've been really following things and really closely what the amount is going to be within a few dollars, and you pay at least 90% of that, then you're going to be in good stead. So again, in that example, if you knew that you're going to have a $20,000 tax bill for the year on the dot and you pay $18,000, why you're going to be in good stead there, avoiding, again, underpayment penalties. That doesn't mean that you're going to avoid that last $2,000, but it does mean that you will be in a place where you're not going to have a penalty. You just got to make that up again as you file taxes. You might also have rental income, from a rental property, which again is going to be a joy to calculate, I'm sure, with an accountant or with tax software. So you've got to be, careful on those kinds of pieces, because sometimes there can be unexpected things that happen towards the end of the year, and you've got to recognize that. But again, safe harbor rules should be able to help you figure out, okay, how much do I need to pay through the course of this year? And if you need to set up estimated payments, then you can do so.
Right. Well, and I think another key point that you started to bring up was the timing of those payments. And the reality is, even if you just waited until April 15th and said, okay, I'm going to make the entire lump sum payment right before the deadline of when it's due, the IRS doesn't really like that. They want income to come in on a regular basis, just like you and I like income coming in on a regular basis. So talk us through the timing of these payments.
Well, estimated taxes are due 4 times a year. So you've basically got April 15th, June 15th, September 15th, and then the next January 15th. So you kind of think about this on a quarterly basis. The government is saying, well, we're going to give you a little bit of grace here in that first quarter because you're probably still thinking about taxes from last year. So we're going to expect that on the first quarter of income that you have, that you pay us by April 15th. Now, the second quarter is interesting because they're going to double up here on you. They're going to say, well, you should have been done, with your taxes and filing and everything. And so we're going to expect that second quarter of taxes that you pay us towards the end of that quarter because you should know, basically how everything's lining out there. So we're going to expect June 15th for that second quarter. Same thing for third quarter, except we don't have 2 payments in the third quarter there. So September 15th, you're getting towards the end of the third quarter. And then they're looking at things and they're saying, well, by the end of the year, we want to make sure that we give you space to be able to figure out what's going on the entirety of the year and maybe true up a little bit. And so January 15th of the following year, so a couple of weeks after the year end, is when the fourth quarter taxes are due. So generally speaking, clients will pay those estimated taxes. If they need to, they will make those estimated taxes in equal installments through the course of the year. They can estimate that in different ways. And let's just say that you sold a lot of highly appreciated stock in the first quarter, and you had a big capital gain. Then you should make a bigger estimated payment in the first quarter, because if the IRS looks back and says, "Oh, you realized $100,000 of capital gain in the first quarter," they may penalize you if you don't match an estimated payment to that. Right. For a lot of our clients, though, what they say, what they would look at is they have some kind of non-qualified account with income, dividends, interest, capital gains that comes in, over the course of that year. They're not having taxes withheld from that. They might not be having taxes withheld from Social Security or pension. Right. And so the payment would need to be estimated more in an equal type of situation through the course of the year.
Yeah. So, Spencer, one thing that we often talk about with clients is the difference for where withholding from an IRA distribution or pension or Social Security, and how that is timed and seen differently from the IRS, and how we can use that to maybe strategically plan taxes. You want to talk about that?
Yeah, so this gives us an opportunity for tax planning, particularly on IRA distributions, because these sometimes don't come in equally through the course of the year, but they are counted equally in the eyes of the IRS in terms of being spread out. Pensions and Social Security withholding, those tend to be nice to just go ahead and figure out the amount that should be withheld. And Social Security has different thresholds that can be withheld. You can either elect to withhold 7%, 10%, 12, or 22% of your Social Security income. So going ahead and determining how much should be withheld, if you withhold any, is nice there. Again, because it's just spread out over the course of the year. If you get close in one particular year, then you can set it and forget it. And those payments are going to go just as you're paid by Social Security. The federal government has paid the tax that you're estimating, would be due on that. Same thing can be said for pension. Oftentimes, pension withholding can be done in a variety of different ways. Sometimes it's on a percentage basis. Sometimes it's just on a flat dollar basis. But you can usually set those values. And again, once you set it one time, often you don't need to reset it for the future. You just kind of keep it there and you adjust your other tax planning pieces around that. Now, IRAs give us an interesting case here, because sometimes IRA distributions are taken out over the course of time, and you might have, might take those resources out quarterly. And so as you pay, as you have income, you can match tax payments, with each one of those. But again, the federal government is going to look at it and it's going to say any kind of tax payment that comes from a withdrawal from an IRA is going to be treated as spread equally over the course of the year. So let's think about 2 scenarios. Let's say that you have a $50,000 tax liability that is going to be due. It's going to be due. You haven't withheld from pension and maybe consulting income and dividends, what have you. You know that you're going to need to have $50,000 pushed to the IRS. You can do this over estimated payments, for on a quarterly basis, $12,500 a piece, or you have a $50,000 IRA distribution, and you could push all of that to the federal government. Right. Well, you could push all of that to the federal government on January 2nd, or you could do so on December 30th. Yep. But the federal government's actually going to look at it in terms of the timing in the same way. If it's in that calendar year, they're going to count it as being spread across the course of that calendar year. And of course, I don't have to tell you that if you are able to keep those funds, and even if you held them in a money market account, making 5% on an annual basis, that $50,000, if you pay it January 2nd, the federal government's going to get it earlier. So they're going to have an accrual of those assets over time or use them more quickly. If you defer your payment to, say, December 30th, which pay before that, don't wait until the second to last day of the year, but pay before that, then you might have an extra 5% that's made off of those funds. Again, not violating any of the pieces of how the federal government's going to look at this, because they're going to look at that spread over the course of the year. So IRA withholding can actually serve as a catch-up strategy of sorts. And we have a lot of clients that go ahead and they defer their required minimum distributions till towards the end of the year, because they might want to do qualified charitable distributions, or they may want to take resources out for one reason or another. The nice thing is, if we've got a distribution that needs to come out, whether it's the entirety of the RMD or just a smaller part of that required minimum distribution, we can true up, so to speak. It's a catch-up strategy if we need to. So if we say, oh gosh, we need another $5,000 to go to the federal government, and we've got a distribution that's $10,000 on a month-to-month basis, if we're only taking, say, 20% of that and sending it to the federal government, while the last one we might take 70%, we might take an extra $5,000 and send it to the federal government as that catch-up strategy. So that's a nice piece of IRA withholding. And to your point, we can do that on Roth conversions as well. Now, the ideal strategy for Roth conversions is actually not withholding on the conversion itself, because we'd like to have more dollars getting into that Roth IRA. But we can always, if we know that we're going to have a tax bill due, we can always have resources pushed in the midst of that conversion and tax withheld. So that is one option if we're looking at Roth conversions.
Well, and I think the other piece that allows you, if you withhold or you wait till end of the year to do the withholding, and let's just presume here you're not waiting until the December 31st deadline. You're looking and saying, okay, I'm going to push this distribution out maybe early December. If you've got a large non-qualified account with mutual funds that push out capital gains, it gives you a little bit more flexibility to say, okay, what is my capital gain distribution? Is it higher or lower than I anticipated? Maybe I need to withhold a little bit more on this distribution. Maybe I need to withhold a little bit less because there's not a capital gains. It allows you some flexibility to adjust for those variable sources of income. So when we think about those variable sources of income, capital gains, dividends, K1s, how do we adjust for those?
Well, the best approach typically is that we look at last year's return. How much came in dividends? How much came in interest income? What did the K1 look like if we're receiving funds from a limited partnership or a trust or something like that? What did it look like last year? And then if we know that it is quite variable, quite volatile, then we reach out to the folks that might have a better idea. So, if a K1 is being issued and the CPA who's helping to issue the K1 is available for comment, then we may reach out to that person. If we have a mutual fund company that has an idea of what the estimated capital gains will look like, might be reaching out to them. If there is a dividend level of income, usually last year gives us the best indication of what will happen this year, but sometimes those dividends can be quite different too. Sometimes there's a special dividend that might be issued. So we have to be careful with that. But we do want to recognize that starting with last year, making some adjustments, and then if anything, if we are still within those safe harbor elements of having the tax withheld, then if we get the K1 and it's not issued until into the middle of the year, at least we've still done what we need to abide by the safe harbor rules, and we can pay what we need to as we file taxes, but we're not going to face the same level of penalty because at least we've abided by safe harbor rules.
So that kind of dovetails into that last piece, is the reality that you either need to coordinate with your CPA or a financial advisor, or the realist scenario, you probably need to coordinate with both of them. So why is this so important? Well,
if you have a level of uncertainty, this can be helpful. Now, on some level, if you have K1s that are wildly different from year to year, you're probably just going to have to go with the safe harbor and make sure that you've paid enough and that you've paid in a reasonable sequence there with estimated payments maybe through the course of the year. And then you're going to have an amount that either you receive because you didn't have as much of a tax bill as last year, or that you've got to pay, and you've got to get comfortable with that. But working with your CPA just to make sure that you've got a good idea of how much needs to be paid in estimated tax payments, or if you need to change the withholding. That's one of those things that can be really, really helpful, is if we have a high enough level of withholding that we're not constantly having to increase a level of IRA withholding, even above, what would be expected. There are times even when a client will have more needed payment than the IRA required minimum distribution. And that's a circumstance where we don't actually want to add more distribution to the IRA just to pay tax, on that. We would much prefer just to be able to take the entire distribution if need be and push that to the federal government. But taking an extra level of distribution, you're just adding income and then increasing that tax bill even there. So we want to make sure that to the extent that we can, we've got a reasonable level of withholding on each of the income streams. We have a sense of what we're going to need via estimated payments, and then the IRA distribution can become a plug towards the end of the year if we need to add or subtract distribution there.
Absolutely. So Spencer, thanks for walking us through this idea of avoiding estimated payments or avoiding penalties on our taxes. The reality is you can avoid the penalties. You just have to be diligent. You have to be aware of what your last year's tax bill was, where your adjusted gross income is, and then maybe even what your future tax bill looks like this year. Clients, if you have questions, feel free to reach out to us. As always, don't take this and just kind of run with it. Bring it to your financial advisor, bring it to your CPA. Make sure that you are making the right decisions for your financial plan in concert with your experts. As always, feel free to leave comments down below, and we look forward to seeing you again next time. Take care. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.